I'm not a macroeconomist. This channel was based purely on my curiosity of innovation, technology, markets, and technical analysis. The people who I follow allow me to create the framework for the decisions that I make. Cern Bash, one of the best financial analysts on the planet. Joe Badgie, one of the best pioneers, understanding innovation and thinking 5 years ahead into the future. You've got James Invest Answers, one of the best stock pickers in the world. He's able to understand depressed and undervalued companies and assets and commodities. You've got James E. Thorne, one of the best macroeconomists. You've got Raoul Pal, one of the best macroeconomists who created the Everything Code, which is basically the business cycle determines asset direction. You've got Julian Bittle as an extension to Raoul Pal, and together their research shows the framework for where markets can go directionally over the short, medium, and long term. So in this video, we're going to go through the economy. We're going to go through what's driving the economy, what will drive the economy, the data, the charts. We're going to go through Bitcoin, technology, and just understanding that this video is not time sensitive. It's important to try and consume this information as early as possible, but this is going to set out the framework for the next 5 years. And so try and understand these data points, and I'll add my commentary to what I believe and how I interpret this. Without technology, the US economy would be in a recession. You can see in this chart, the total real GDP is currently just over 2%. But if you exclude tech spending, it would drop it down to just under 1%. So the actual impact of building out data centers, investing in AI, the expansion of compute is starting to impact the economy meaningfully and actually grow real GDP. This data point from Goldman Sachs shows that outside of a recession, the Fed rate cutting cycle has usually been the catalyst for the S&P 500 and equities to increase upwards for the quarters that come after. So this could take us into 2026. And for now, understanding the framework of the Fed starting to cut, this is going to start to meaningfully impact equities, the S&P 500, as we are outside of a recession. Understanding the Everything Code that Raoul Pal has coined, one of the most incredible reads, and trying to understand that everything is broken. There's no need to diversify when you have this annualized debasement. And it all comes from the growth of the liquidity. 8% annualized growth rate of the liquidity. This is the money supply. This is debasement of the currency. This is more dollars in circulation, which means that it artificially inflates all hard assets. And therefore, they don't meaningfully move or outperform this debasement. They just grow at the same rate of debasement. If there's more dollars in the system, then everything's going to go up nominally. It's not going to go up meaningfully. It's not going to outperform this 8%. You can look at the absorption of empty money supply, this annualized increase in liquidity, and the housing index, and it's grown at about the same percent, 9% for the housing index and 8% for the debasement of currency. So you think about how you outperform this, and in this video, these data points should give you a direction of what you should be investing in, and I would say straight away it's AI and crypto. The reason why we have more positive financial conditions to look forward to, the total 12-month net liquidity flow, when you take into account the Fed, the People's Bank of China, the Bank of Japan, the ECB, the Bank of England, when you take into account these big central banks, they still haven't gone over neutral yet. So we still have more room for all of these banks to start to inflate and increase liquidity in the system. Just take that data point, understand that that shows that there's still more room for that liquidity to expand, and every asset will nominally absorb this extra liquidity. And so it is quite simple. The short-term daily noise, if you're trading the hourly candles, then you're going to be in a position where you're gambling. But if you're trading this multi-quarterly, or you're trading this multi-yearly, or you're trading this on a month-to-month basis, then you're going to be able to really capture the trend. And that trend, just based on this liquidity, is up. Look at the correlation between the total liquidity index and Bitcoin. They are so closely correlated by 90%. The correlation of the global index liquidity going up is basically Bitcoin's entire move. And then it outperforms as well on top of that. But the entire move of Bitcoin is just this absorption of this extra liquidity. Bitcoin correlates by 90% to the increase in global liquidity. The same with the NASDAQ. It increases as the liquidity increases. By 95%, the correlation between these two assets is so similar. The total liquidity index year over year is going up. And there is volatility. It doesn't go up in a straight line, but it is trending higher. This should continue. The central banks haven't gone over the neutral rate yet when it comes to a 12-month basis. There's still so much liquidity to be stimulated into the economy. So we have got so much more room to run if you think about these indexes and you think about the financial conditions growing more positively over the next 3 to 6 months. The global M2 and the NASDAQ correlation, again, just so clear on this 12-week lead. It's just perfectly correlated. Does it deviate? Yes, there are moments where it deviates and it doesn't completely correlate on a line-to-line basis, but over time, the direction is what you're thinking about. An investor has the luxury of being able to have time on their side, and so directionally, they need to be right. Whereas a trader, they need to position themselves and perfectly time all of this volatility. So if you're not a trader and you're not using leverage and you're an investor, you want to be an investor in this trend, and that trend is higher. This is a really interesting chart, and all these charts come from Raoul Pal. I watched his podcast twice, and it's about an hour and a half long, and I watched it twice, and I really thought about how this impacts my decisions. And I have made decisions based on this data. And so if you don't have the time to watch it, hopefully this short condensed version where I just take the highlights, but this is his information, his data, Julian Bittel and Raoul Pal. And hopefully you can just see that these charts really do paint the picture of where we could go over the next 3 to 6 months. And I say 3 to 6 months because I don't want to go too far. My time horizon is slightly different with some of the positions that I hold. But over time, I'm going to be invested in this upwards trend. You can see that the 1996 to 2001 S&P 500 move is kind of similar to today. It's actually quite similarly correlated. I'd say it's about 90% correlated. Now, if we zoom in, there's some micro insights where the 20 daily moving average is usually a good place for retail to step in. The institutional investors like to step in on the 20 weekly day moving average. So it's a lot lower. They like to move with big positions at those points. And that's where if you are able to get those types of buying opportunities, that's a generational buying opportunity. But the retail investor likes to step in a little bit earlier, and that keeps the S&P 500 and equities continuing to bounce. And this 20 daily moving average seems to be a really good support at the moment. And whenever there is a super overbought period of time which marks a local top for the S&P 500, it's usually when the S&P 500 is 15% above the 200-day moving average, which it currently isn't. So there's still room for that to continue to expand. Now let's talk Bitcoin. We have this money supply and Bitcoin correlation, but it has deviated and it's no longer correlated. And since July the 16th, it stopped correlating to the money supply expansion. And there's a reason for that. And Raoul Pal managed to uncover that insight. And it's basically Treasury General Account is taking out liquidity from the system. And that basically draws down and marginally impacts Bitcoin the most because it's the furthest out on the risk curve. And so it's going to be the one that's impacted the most when the Treasury General Account takes liquidity out of the system. That 500 billion that's been withdrawn is going to be extremely negative for Bitcoin's price action because it's really a function of money supply. So the Treasury General Account taking liquidity out, it's going to that point where it's about to mean revert and it'll go back into the system again. And when it goes back into the system, Bitcoin has a very similar path to 2015 to 2017, where it goes on this extreme parabola around this time into Q2 of 2026. And going back to the Treasury General Account, you can see on the DeMark indicator, it's starting to flash a reversal. And when this reverses, it simply means that the money is going to go back into the system. That 500 billion that was withdrawn by the Treasury to replenish their reserves is going to go back into the system, and it hits the assets like Bitcoin the most. Another reason why the implied price of Bitcoin is lower than it could be and should be is because the ISM has still not started to trend above 50. And that means that there's still so much room for Bitcoin to continue to run. The ISM simply signals an expansion in the market. When it gets over 50, that's when all risk assets start to benefit the most from the ISM and the sentiment that it brings, the new orders, the CEOs having a lot more confidence in the direction of the markets, people having more money in their pockets, it's going to hit Bitcoin. And therefore, the ISM still is in this trend sideways. When it breaks above 50, that's when you start to see the acceleration moves of altcoins and Bitcoin. This is a Bitcoin chart to the NASDAQ. And again, it's showing on the DeMark indicators that it's about to reverse and it's about to now outperform the NASDAQ. You never get a top in Bitcoin when the ISM is under 50. It's one of the biggest variables for the direction of Bitcoin. And so there's still room, if the ISM is under 50, for Bitcoin to expand. In my opinion, in what I believe, based on this data. The ISM expansion then starts to hit the altcoins that are further out on the risk curve. So Bitcoin moves first, and then that liquidity flows in to ETH, Solana, and then further out down the risk curve. And then the altcoins that are extremely speculative will start to move as well. But there's so many altcoins now in the market that they can't all absorb the same level of liquidity. So you have to be a sniper in the woods when it comes to deciding which altcoins you're going to position in. And it's usually best to just have the top 10. Solana, Hype, Sui, all of these chains are being adopted. They're all being used and their users are growing. And therefore, why not just have those assets as the riskier part of the portfolio? Now, let's look at interest rates and focusing firstly on the Financial Conditions Index. It leads by 9 months, and therefore the ISM still has so much room to run when you think about how far the Global Financial Conditions Index is. When it trends higher like this, it signals an ISM reaching 58%, which is quite low historically, where it's been over 60. The reason why the Bitcoin cycle has changed and slightly extended is because of the maturity of the debt. A lot of this debt is being refinanced at 1 to 5 years rather than 4 years. Where it used to be 4 years, the debt would be refinanced and the interest rates would be lowered to refinance that debt for the central banks. It's now taken up to 5 years. And that period of time, you can see 35% of these debt instruments are at 1 to 5 years of maturity. It extends the cycle because basically Bitcoin is just a debt debasement cycle. You can see the 2-year yield starting to go up and the ISM follows this. And then the sine curve shows that the ISM will follow this new debt cycle, this new maturity cycle of 5.4 years. The ISM, based on this data, has still got room to run. It's still got room to climb higher. The extension of this cycle is based on the fact that this maturity of the debt is now over a longer period rather than being the 4 years. It's now 5.4 years. It extends the cycle. So that could see Bitcoin extend into 2026. The Everything Code Dominoes shows that at 9 months, forward-looking indicators like gold and the financial conditions, they move first. And then 6 months ahead, you've got the global money supply. That's got a 6-month lead. And then you've got Bitcoin and tech stocks and the yield curve at 3 months ahead. And then you've got the lagging indicators, which is what the central banks use, which is inflation rates and GDP growth. These assets like gold and Bitcoin, they move ahead of these financial conditions improving. And the reason why we have more positive data for inflation coming out is because the shelter component is about 35%. And that is a 17-month lead. And that's starting to come down. The cost of homes, the cost of rent. Now I want to look at some of the data points that have the biggest impact on the way I view the market. You can look at these companies, the valuation of the largest stocks today versus the tech bubble. And in 99, you have the top company, Microsoft, trading at a 69x PE, whereas Nvidia is only at a 30x PE. If you come down this list, the current PEs of these big companies are a lot lower outside of Tesla than the companies that were trading in the just before the tech bubble. So if you think about the median being 41x during the tech time, then the median now is only 31x. And we've got a true impact meaningfully from AI and data centers. And so if the tech bubble had a higher PE before it collapsed, the AI will actually meaningfully impact economic data in a positive way. And that's still got a lower PE of 31x. It shows that there's still so much room to run. And even though the S&P 500 is trading at 22x its multiple of forward earnings, which is historically very high. It's not relevant if you think about how much more room these companies have to run when you compare them to the equivalent of the tech bubble companies. Calls for correction show that from 2009 all the way to 2025, any meaningful correction of 20% or more doesn't last that long. And it can be a very small blip in the radar, and it can provide a very good opportunity for generational wealth. It happens quick, it comes down fast, and then it recovers very quickly. So to try and will these corrections and wait on the sidelines in cash is the most detrimental decision that you can make for the long term. And it is this simple. Going back to 1928, the odds of beating the S&P 500 while sitting in cash. So over a 30-year period, it's 0%. Over a 20-year period, it's 1%. Over a 1-year period, it's only 30%. So what I take from this is over a 1-year period, you're only 30% likely to outbeat the S&P 500 sitting in cash and being on the sideline, which means that 70% of the odds favor being invested. Going to the Robert Shiller cyclical annualized PE ratio, you can see that historically 44 is high, 33 is high, but we have so much more room to run when it's only at 40. We still have more room to run to get to the tech bubble of 2000s, but also we have so much more growth and expansion, and the actual economic data is showing how AI is meaningfully impacting in a positive way the growth of real GDP. Whereas in the tech bubble, you could just simply assign a .com to your business and get an extremely high multiple based on it being considered a tech company, when actually it was nothing more than just a front. US e-commerce is starting to take up 16.3% of the actual total retail sales. You've got these massive companies that are starting to grow in the US, and that's why I believe the US is the economy to invest in, because you can see how many trillion-dollar companies they're creating. And I want to finish off, as always, with how it could all be relevant. I'm going to look at just tech. I'm going to look at the understanding of intelligence and just mercantilist societies where they try and protect their businesses and keep them localized. So India and China, mercantilist countries where they try and protect their businesses and keep it within the nation. So when you think about the impact of humanoid robots, you can see in this data by Emad Modzak, prediction in a few years, China will stop exporting robots and use them all internally. Solves the population pyramid issues. Homegrown AI will be ubiquitous. Highest return on investment is using them locally. Accelerates China's industrial advantage even more, backed by plentiful energy. So China are going to start to become more mercantilist by having their humanoid robots internal rather than exporting them and giving other countries the advantage of having this type of labor. And this JP Morgan data insight really stands out. It's basically that data center investment and spending is starting to go above office spending. Electric power is starting to soar higher and higher, hundreds of percent. But the actual investment in data centers is showing that there's a move to being more digital, more online, more flexible in how you work. And the office space, commercial real estate is starting to really suffer and is in currently a recession. And this is another really interesting data point. The US is investing more in the military to protect Taiwan because of their Taiwanese semiconductor fabrication facility. This foundry that basically produce the hardware and the semiconductors for the AI chips for NVIDIA, for Tesla, are starting to become an extremely important asset. And that's one of the main reasons why China wants to invade. And not to go into anything political, but you can see that the investment in the military protection of Taiwan from the US is more than the technology investment. And that's because they understand the value of semiconductors. And to add some levity, you've got Wall Street, artificial intelligence, heck, we aren't even long regular intelligence. And it just shows that where this AI revolution could go is still misunderstood by the big money managers on Wall Street. Cern Basher points out that retail investors, yourself and I, the advantage that we have is that we can look into the future. While Wall Street focuses on the next 12 to 18 months, retail investors can focus on the next 2 to 3 years. And therefore, you can front run Wall Street. And this is the advantage. This is what algorithms can't predict. This is what money managers can't do because their quarterly results are what impact their decisions. Having the ability to go 2 years into the future, I never realized is the advantage. And it's the way I started. I understood that I had a time frame of a few years with some of the allocations that I made to very specific investments. I went through the volatility, I went through the fear, I went through the understanding that this could all go to zero many a time. And it was having the longer term mindset, knowing that I didn't have to worry about any performance review. And I had the time to be able to let those investments mature. And that's where I realized the only advantage that we have as retail investors is that we can have the time in the market over these institutions. And the whole point of any level of wealth accrual is that level 1, you cut your own grass. Level 2, you pay someone else to cut your grass. And then level 3 is you cut your own grass. And basically what it's saying is all I see money as is time. Time to be able to have the flexibility to make the decisions that you want to make, be where you want to be, live where you want to live, and have time to work on projects and passion projects that you love. So it's just a tool to unlock time. That's all it is. I believe that the investments that you make should be seeds to provide you with more time in the future. And so just finishing off with that final point and something that I want to be able to look back on in a few years. And if I have managed to make good decisions now, hopefully I'll be rewarded in the future or not. Either way, this journey is incredibly fun and I don't take it too seriously. You can't in the markets because the volatility can really melt your face up and down. It can be extremely exhausting. But if you understand that there are companies and there are opportunities like Tesla, I always talk about this, Nvidia, they have so much more room to run. So follow Raoul Pal, follow Julian Bittel, follow James E. Fawn, follow Invest Answers, Cern Basher, Jeff Lutz. Take these names, have them on your X, and just make them the priority of your day. Try and take what they're saying and just apply it to your life. All I do is just share my interests and my curiosity. It's never financial advice, but it's definitely something that I enjoy doing. And it's just tech, innovation, markets, and technical analysis. Like, comment, subscribe. See you in the next one. Bye.